Hey guys, my name is Colin and this is Colin Talks Crypto. I'm going to show you something very interesting. It's a correlation between the effective federal funds rate and the S&P 500. There are some clear patterns. Based on these patterns, I have created a forecast and projection for how the stock market and Fed rate is going to unfold over the coming 2 to 3 years. If you don't want to stick around until the end, what I'm going to show you postulates a pivot in the federal funds rate around March of 2023, followed by a bottom in the S&P 500 with a score between 2100 and 2500. That's the chart you're looking at right now. You're looking at a comparison between the S&P 500, the orange line, and the effective federal funds rate, the blue line. Recently, as we all know, the Fed has been hiking interest rates by 75 basis points per session. And let's take a look at the effective federal funds rate real quick here and define it. So straight from the Fed's website, the federal funds effective rate is defined as the averages of daily figures reported monthly for the interest rate that the Fed gives to the banks. Now, why is this important? Well, the federal funds rate is the target interest rate set by the FOMC. This is the rate at which commercial banks borrow and lend their excess reserves to each other overnight. The federal funds rate can influence short-term rates on consumer loans and credit cards. When the Fed makes it more expensive for banks to borrow by targeting a higher federal funds rate, the banks in turn pass on the higher costs to their customers. This means that interest rates on consumer borrowing, including mortgage rates, tend to go up. This is why it's more expensive to buy a house. It's because of this Fed rate that we're looking at. All right, so let's go back to this chart I've made for us here. Now you'll notice some vertical blue and vertical orange lines. The vertical blue line signifies every time the Fed basically stopped increasing the federal funds rate and it began to drop. So you can see these examples here where the Fed was increasing the federal funds rate and then stopped and decreased it. That peak right there represents the pivot point between increasing and decreasing the federal funds rate. You can see that peak represented here, 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 and we're going to postulate in the future where they might pivot next. Likewise, the vertical orange lines correspond with the bottom of the S&P 500 cycles. So you can see the S&P bottomed in 1970, 1974, 1982, 1990, 2002, 2009, 2020 with the COVID crash, and we are again going to postulate where the next bottom of the S&P 500 may lie based on the correlation between these two events, the Fed pivoting and the bottoming of the stock market. Now, I don't know if you guys are like me, but before I looked at this correlation and before I charted it, I thought that the market tends to get bullish when the Fed drops the interest rates. As soon as the Fed starts indicating that they're going to slow and then reverse the interest rate climb, that to me, from what I gathered, meant that things were going to get very bullish very quickly. Well, if you look at this chart, the first big lesson to learn is that is not the case at all. In fact, in the majority of cases, whenever the Fed pivoted, indicated again by that vertical blue line, it was followed by a massive decrease in the S&P 500 over a period of many months. In fact, it's the exception to say that something otherwise occurred. So what we're looking at right now is how does this correlation play into the future for our forecast? What's that going to mean for us here? We've seen a peak on the S&P 500 earlier this year, and we've been dropping ever since. And that is timed exactly with the Fed fund rate being increased every month or so by about 75 basis points. Now, they've indicated that they're going to start to slow that down possibly in the coming months. So we're going to extrapolate what that could look like. Now, one more thing I've done is I've highlighted with these kind of red boxes the drop in price from the peak to the valley of each of these S&P 500 cycles. You can see here's 36% drop, 48% drop, 27% drop, on up. We have 51% and 58% drops. We saw a 35% drop with COVID, and currently we are in the middle of a drop and we don't know exactly where it's going to end. But let's take it one step further. And what do we think might happen here? And if you sort of step back and look at what's happening, we have these patterns where we have a rise of the Fed fund rate through all of these climbs like this. They last for almost about the same amount of time, really. Here's a rise in the Fed fund rate, rise in the Fed fund rate, and right now we're in the middle of a rise in the Fed fund rate. And so the question is how long is that going to last? And this is what I have displayed as my guess for what's going to happen. The light blue line here is the path that I think we may follow. I've basically decreased the acceleration of it for the immediate future because there is indication the Fed may start doing 50 basis points increases in the Fed fund rate instead of 75 basis points. That doesn't mean that it's decreasing. It just means it's slowing down. And you'll notice there's also often a flat period where they sort of level it out and they sort of, I guess, test to see the effects that the change has had. So I wouldn't be surprised if we see another flat period following that decreased acceleration. Another correlation that's very clear is that, like we said at the start of this video, every time there's a pivot indicated by these vertical blue lines, that is when basically the stock market begins to tank the most. That is the pattern we see. So if we postulate that the Fed will pivot around March of 2023, based on the general pattern that these cycles take and the amount of time it takes for a pivot to occur, we can then extrapolate that the S&P 500 is going to begin its biggest drop around that time. And this is just approximate math, guys. Like, give me a month or two leeway on either side of this, and let's call that, if that happens, an amazing forecast. Nothing's going to be exact. None of these squiggly lines are going to be exactly the way you see them. But I think that within a month or two of March next year in 2023, we're going to see both a pivot on the Fed and we're going to see another leg down in the stock market down to its actual bottom. Now that brings us to where I think we might drop down to. And I've actually drawn on here these two gray lines. And these represent major support points on the chart. This is more of just technical analysis. You can see that around the 2500 S&P 500 score was essentially the bottom of the COVID crash and the bottom of this other little dip right here before that. So that forms a pretty strong support base if we were to kind of guess where the next support might lie on this chart. Now the next level below that support range is around the 2100 level on the S&P 500. You can see there's a ton of support right around here between 2015 and 2017. And so that would be the next most likely support range. Below that, we would be down here at the 2008 highs or the 2000 highs, both at the top of those major economic events. But let's say that we're being a little conservative. We're not going to drop all the way down that far. Again, looking at the past patterns, we've seen that 51%, 58% is kind of the high end of the spectrum. 20, 14, 36, 48%, that's kind of the middle range of the spectrum. So to expect we would go somewhere between this support range of 2,500 on the S&P and 2,100 on the S&P would give us, I did the math on this, it would give us a 48% drop to a 56% drop, which is right in the range of what we'd expect from a larger size bear market / recession. So I think this is a very realistic prediction, and it really puts things in perspective because I'm sitting here looking at when we might bottom on crypto being heavily correlated to the stock market, and I'm realizing that we might have a lot longer to go than we may think. If we forecast that the pivot triggers the S&P 500 dropping, then this is what it could look like. It could look like we actually drop down to July 2023 as our market bottom for the S&P 500. So it's interesting because crypto is very low right now. Like Bitcoin's at 16,000. I would not be surprised in the least for Bitcoin to reach the $12,000 price range, maybe a wick down to $10,000. Somewhere in that price range seems likely to me. But I feel like we're heading there a lot quicker. And so with all the contagion that we're seeing surrounding this FTX collapse and all these other organizations going under, these smaller exchanges going under, all these loans that are unable to be paid back and all this customer funds that have been lost, it indicates a lot of collateral damage that is coming down the pipeline. And so it just seems like we might hit that Bitcoin low rather soon in the next couple of weeks, perhaps. by the end of the year for sure. And if that's the case, what does that mean for a further S&P 500 drop in July of 2023, give or take a couple months in either direction? Would we see another low, or would the Bitcoin low already be in? Historically, it is possible for Bitcoin to bottom before the S&P 500, but this is a little bit unlike anything we've ever seen because we've never been in the middle of a massive recession, depression level event while Bitcoin has existed. Keep in mind, Bitcoin was invented in 2009 in response to this event right here. Literally, this was the birth moment of Bitcoin. So this entire time, the S&P 500 has just been up, 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 up. We have not had a recession or depression of any significant magnitude during Bitcoin's lifespan. So we don't know exactly how it's going to react. And I would say that is the only takeaway I would like you to all have, is take a look at how long this could take to unfold just based on the past performance of these drops. The drop we could see could take us down to an S&P 500 score of 2,500 or 2,100. And I don't know exactly what effect that might have on Bitcoin or Ethereum or the other altcoins, but I suspect not good. And as Bitcoin and Ethereum and all the rest are heavily correlated, at least thus far, with the stock market, I can't see that being a good outcome. So my gut tells me buy on any major capitulation down to the $12,000 range for Bitcoin. If we see it down below 14,000, that's probably a very good long-term buy if you're planning to hold for many years. But also perhaps keep some dry powder on the sidelines because we don't know exactly what's going to happen when the S&P 500 truly bottoms out. And if you're thinking to yourself, well, that might bottom out really soon, keep in mind, the Fed has not pivoted yet. The Fed is still increasing. We're still on this upward trajectory. And every time we're still on this upward trajectory, it means we have quite a ways to go before they actually pivot. And we have yet a ways to go before the actual bottom. That's the entire point of this chart. The S&P 500 bottoms are almost always delayed after the Fed pivot. So I think we have quite a ways to go. So in summary, once again, I postulate a pivot in the Fed funds rate around March of 2023, give or take a month in either direction, and a bottom to the S&P 500 between a score of 2,100 and 2,500, which is these major support lines, around July of 2023. Let me know, guys, what you think. If you think this is a realistic outcome, if you think this is a too crazy high of a drop to have experienced, even though we've experienced it before. And what do you think is going to happen with Bitcoin? Do you think that Bitcoin will somehow bottom out prior to this collapse? Or do you think that we are going to actually see Bitcoin's final capitulation all the way in July of 2023? And to what level do you think that might be? I think it's anyone's guess. But I'm definitely not putting my money in the market just yet because I realize we have a lot longer to go than we all think. And my friend actually has a theory on why this is the case. We all stay glued to the media. We stay glued to the internet. We stay glued to the charts, especially those of us invested. I bet you many of you guys are watching the stocks and crypto prices every day, if not many, many times per day. I know I do. I probably check the Bitcoin price more than a dozen times a day, and I'm just glued to it. And so my friend's theory is that the closer we are glued to an information source on a particular topic, the more condensed our time horizon in our minds psychologically becomes. And the effect this has is that we expect events to happen much sooner than they actually happen. And that can play into a bit of a FOMO effect, not wanting to miss out on the bottom. And we are then effectively caught trying to catch a falling knife when we really should be a little more patient and step back and breathe and look at these macro charts so that we don't jump the gun and rush into something where there may be a much better opportunity on the horizon. So I think that that's very good advice, and I'd like you guys to consider that as well. That's all I have for you. Have a great day.